which are joint operation. The short form is JO, and joint venture, which is JV. Okay, and then with regards to the accounting treatment, of course, if you still remember, priorly we are applying the acquisition method when we are incorporate the intercompany transactions, okay, by incorporating different types of group structure, okay. So the process of preparing the consolidated financial statement, okay, either financial position or profit and loss and other comprehensive income, as well as the statement of changes in equity. Okay, basically what you have done earlier, actually you are applying the method we call it acquisition method. Okay, but when we are dealing with joint venture or joint basically joint venture, okay, because for the treatment, okay, we are looking on the joint venture. Okay, so we are applying another method, okay, because in order to prepare the consolidated, okay, financial statement, okay, when we have the elements of joint arrangement, okay, so we need to use another method, okay, which is equity method. So basically you must able to explain, okay, the principle of this equity method, okay, as compared to the acquisition method. Okay, so now you should know that you have apply two different methods, and then at the same time you must able to differentiate these two approach. Okay, so when talking about joint arrangement, okay, actually is being covered under MFRS 11. Okay, so MFRS 11, okay, so before that, okay, I'm referring to the textbook, Jane Lazar. Okay, if you have the this is a 9th edition, okay, you can refer to chapter 40. So all the contents in the slide actually taken from the Jane Lazar textbook. Okay, so this is just summarization. Okay, if you want to know more or you want to understand further, okay, you can refer to Jane Lazar textbook 8th edition or 9th edition. Okay, so when talking about joint arrangement, okay, basically is referring to economic arrangement. Okay, so where, okay, the condition they put here is that, all right, they must have two or more parties, okay, that should involve in this joint arrangement, where all the parties involved, okay, will have joint control. Okay, so if you look at on your slide, okay, or on your screen, all right, the standard itself provide the characteristic of joint arrangement. Okay, number one, okay, parties are bound by contractual arrangement, meaning to say that it should be have documented, okay, agreement. Okay, it's not verbally, but it must in black and white document, okay, or black and white contract. Okay, so when we say that economic arrangement, meaning that, okay, the concept still remain as holding and subsidiary, where we have investor, acquired investee. So in this case, okay, an investor may be, okay, a party or a members, okay, because talking about here they're using the words parties. Okay, so a parties to a certain joint arrangement, okay, with another investors, because the condition they put here is that they must have at least two or more parties. So all these each parties involved, okay, we join, okay, we have a joint control, okay, with the interest, okay, the purpose creating this arrangement because their interest actually over the asset and liability of the investee. That's why they call it economic arrangement. So one of the characteristics, as I mentioned earlier, you must have documented contract, okay? Meaning that black and white, okay? And then the contractual arrangement give two or more parties joint control of the arrangement, okay? So they not only bonded, okay, with the contract, but also they also have, okay, the power, okay, to control, okay, the joint arrangement, okay. However, in this case, all right, the power will be sharing, all right, because the members, at least two or more parties. Okay, so what is joint control? Okay, so if you refer to the textbook, all right, you can refer to page 505. Okay, so joint control will be exist when the parties contractually agree to share control and decisions about the relevant activities of the joint arrangement. Okay, and at the same time, okay, joint control also must have the unanimous consent. Okay, unanimous consent means they have having an agreement. Okay, all the parties involved must agree. Okay, whatever on whatever decision making that they're going to have after that. Okay, whatever decision making they want to make related to the relevant activities, and then the parties involved also should act together to direct the activities. Okay, meaning to say that no single parties control the arrangement on its own. Okay, because whatever must have done together. Okay, with other members as well. So a party that has a joint control can prevent the other parties from controlling the arrangement. Okay, this is because, if you still remember, okay, in order to have joint arrangement, all these joint control have been put, have been highlighted in the contract. Okay, so the contract will specify, okay, a member A should have control how many percent, how about same goes to B and other members as well. That's why, okay, so the parties that has the joint control can prevent the other parties from controlling, because no single parties can have on its own, and then whatever decision must make together or must have mutual agreement among other members as well. Okay, types of joint arrangement, there are two. Okay, joint venture and joint operation. Okay, so with regards to identifying, okay, the types of joint arrangement, okay, MFRS 11 have give some guideline, okay, in order to determine whether the joint arrangement that we set up is a type of joint operation or joint venture. Okay, where the elements that we need to focus on, okay, in order to differentiate between joint operation or joint venture, actually based on several elements. Number one, by looking at the rights, okay, their rights to the asset, okay, of the investee. Number two, their obligations for the liability. Number three, of course, okay, terms that being highlighted, okay, or the terms that being laid out in the contractual arrangement. And number four, in terms of revenue, expenses, profit, and also loss sharing. Okay, so I was also have shared with you all, okay, some of the notes, okay, that taken from the textbook, okay. on how to identify, okay, two types of joint arrangement. Okay, you can refer to the notes that been shared with you, okay, in the Telegram. Okay, so this one just to facilitate for those who don't have the textbook. Okay, all right. So you can go through, or you can read through that notes, okay, to understand further, because the notes will elaborate further, okay, how to identify for the justification for each factors that being highlighted on the in the slide, okay, in terms of rights to the asset, of their obligation to the liability, terms of the contractual arrangement, and also in terms of their sharing, all right, in terms of revenue, expenses, and also profit or loss. Okay, so this is just comparison in the sum. I just put in summary, all right. So you can see the difference between joint operation and joint venture side by side. Okay, so joint operations is where a few companies may jointly operate a project. Okay, whereas for joint venture, okay, this also may involve a few companies that will jointly operate a project, but they must involve the establishment of the separate entities of any form of entities. Meaning to say that, let's say we have company A and company B that agreed to join together, all right, to handle one project which granted by the government. Okay, and then meaning to say that, okay, that particular company who are jointly together, okay, under joint operation, they will be called joint operator. Okay, where they will come up with the contractual agreement, okay, which identify, okay, what actually their rights to the asset and also their obligations for the liability with regards to that particular project. Okay, so might be company A will identify what kind of asset, okay, will be contributed, or what are the rights of the asset that belongs to A and also to their partners. Same goes to the obligation. Okay, so meaning that they just join together, two different companies just have a mutual agreement, okay, to handle one project. But it's not like joint venture. Joint venture, when we have two companies which agree to join together to handle one project, they are not involving their own company, because they are come up with another new vehicles, okay, which is separate entities to run or to handle the project. So meaning that A and B, we're creating another company for the sake to handle the project. Normally, they call this company as consortium. Okay, just the purpose to handle whatever matters related to the project. All right. So because of they have another separate entity, so the members that involved in joint venture, we call it joint venturer. Okay, so meaning to say that the parties will have no interest in the asset, and parties are liable to the obligations up to whatever capital that contributed with regards to their investment in that particular project. All right, because they have another entity which is separate legal entity to handle the project. So whatever asset, okay, related to that new separate entity, okay, it belongs to that particular entity. Meaning to say that the partners will not have any rights to the asset. They are only liable up to the amount of capital contributed by company A and company B. It's same like partnership. Okay, joint venture is similar like partnership. And then because they are not involved directly, because they have passed everything to the separate entity to handle, okay, the project. Okay, so they are entitled for the profit and sharing only. Okay, so not like joint operation. Okay, because A and B are involved directly with the project. Okay, that's why they have rights to the asset of the project and also liable for the liabilities. Okay, it depends on the share in the specific proportion. So they have to put in the contract what will be their sharing in terms of liability, in terms of their rights to the asset as well as profit sharing. Okay, but for joint venture, they just need to highlight what will be the profit sharing, okay, based on the whatever income that will be generated, okay, from the project that we handle by the separate entities that they have been established. All right, so for joint operation, share of the jointly revenue and expenses will be based on the basis of performance. Okay, because both company or both parties that involved, okay, if they have 2 parties, if they have 10 parties, meaning that the performance is based on the profit sharing will be based on their performance. Okay, they must have one mechanism how they want to measure the performance, okay, by each parties that involved in the joint arrangement. But for the joint ventures, okay, in terms of the performance measurement, it will be straightforward. Okay, so they just decide what will be the profit sharing. Okay, because they are not liable for the they are not they have no rights to the asset. Okay, and the liability they have the ceiling. What will be the maximum amount liability that will be liable to them. Okay, based on amount capital contributed by each members. Okay, now let's look at the accounting for associate. Just now we are trying to differentiate and identify, okay, how the joint operation will be different as joint venture. Okay, then we come to another standard, okay, MFRS 128. Okay, so under this standard, okay, is focusing on investment in associate and they're focusing on joint venture. Okay, if the first step you need to identify, okay, whether that joint arrangement which involving several parties, whether it falls to be joint associate or joint venture. If they meet the criteria to be classified as joint venture, therefore it will be subject to follow MFRS 128 in terms of the accounting treatment. So joint ventures treatment actually similar with the associate. Okay, after this we're going to look at what is associate. Okay, so the objective of MFRS 128 actually to prescribe, okay, what will be the accounting treatments, okay, with regards to the associate and also the joint venture. And okay, this is the time that we're going to apply the equity method, okay, of accounting. So associate and joint venture both are using equity methods of accounting. Okay, all right. Any question, class? Any question? Any question?
No.
Okay, so let's look at the basic principle of equity method. I think after this, I would like to ask you what will the basic principle of acquisition method? Okay, because you have gone through, okay, the consolidation, okay, of the several statement, okay, how you prepare the SOPI, SOPR, and also SOCHE. Okay, so for the equity method means no consolidation. Then why we should include this as part of the syllabus, okay, coverage for FAR620, okay? All right, so even though there will be no consolidation, okay, with regards to the joint venture or associate, but the investment still need to be reported. So the investment in associate or investment in joint venture, okay, will be reported at cost basis. Okay, so there will be a formula how to identify what will be the carrying amount, okay, to be reported, okay, or what will be the carry amount to be recognized as cost of investment in associate. Okay, why this is why we need to determine the investment at cost, because this element should be presented in the consolidated statement of financial position, okay, as part of non-current asset. Okay, if you still remember, okay, when we have investment in subsidiary, okay, we also reported investment in subsidiary in individual statement, okay, especially in holding company financial position, where we can see item, okay, in the financial position of holding company. Under non-current asset, we have item investment in subsidiaries. Okay. Same goes to another entity if they have vertical group structure where subsidiary also can have acquisition in another subsidiary. Alright. But for the equity method, we also have that kind of statement with investment in associate. Okay. However, okay, we are not going to add column by column, okay, like we did for asset and liability. For financial position and also for SOPR, we just add all the expenses and also the income, okay, line item, okay, by line item we just add holding and subsidiary. But for associate or joint venture, we just need to know what will be the total investment in associate, and that amount will be reported at cost. So carrying amount of investment in associate might increase or decrease by the investor's share of the post-acquisition profit of the investee. So the cost, the investment at cost can be increased or can be decreased by the holding company share of the post profit of associate, because in this case the investee is now an associate, no, it's not a subsidiary. Okay, the investor will only include its share of investees, which is associate profit or loss, as a separate line item in the statement of profit or loss and other comprehensive income. This is, we're talking about the effect in terms of the presentation in the SOPR. If previously, okay, just now we're talking about what will be the item to be reported in the SOP, okay, where we need to have item investment in associate, okay, which is at cost to be disclosed under non-current asset. While for the SOPR, consolidated statement of profit and loss, another comprehensive income, we also have one line item which the name is share of profit associate. Okay, if there is a sharing in terms of profit, but it can be also sharing of losses. If sharing of profit, it become an income. If sharing of losses means expenses. Okay, So any distribution received from the investee will reduce, okay, the carrying amount of the investment. Okay, any distribution received by holding company from associate, okay, we reduce the carry amount. This is related to this point, okay, and the earlier point. Current as the carry amount is increased or decreased. Okay, so what kind of distribution received by holding from the investee? For instance, dividend received from associate. So we need to minus. Okay, and then the adjusted carrying amount will appear in the statement of financial position. This one is the investment at cost. Okay, so all this the elaboration for the item with regards to the investment in associate, which should be reported at cost. Okay, and then beside investment in associate which are not held for sale, we also have investment in associate which being classified as held for sale. Okay, what's the difference? Okay, so investment in associate held for sale means the period of holding the investment actually only up to 12 months, meaning short-term period. Alright, maknanya pegangan dia, okay, the investor only invest in associate for short term, okay, 12 months only. So any investment in associate or joint venture that is classified as held for sale, okay, will not applicable here. Okay, we are not going to look into any aspect of investment in associate which held for sale. Okay, because the particular item should be taken care of by MFRS 5. Okay, not under MFRS 128. 128, alright, in terms of the accounting treatment with regards to joint venture and also associate. Okay, alright, so this is talking about investment in associate which are not held for sale. Will be covered under MFRS 128. Okay, so associates as an entity over which the investor has significant influence. Okay, so in the textbook, okay, they have defined, okay, they have include the definition of what does it mean by significant influence under MFRS 128. Okay, so significant influence actually is the power to participate in the financial and operating policy decision of the investee, which is associate, but no control of those policy. Okay, they only are able to participate, but they don't have the element of control over the policy. Okay, that's a different compared to subsidiary. Subsidiary, okay, they have power to involve in financial and also operating decision, as well as to interfere in any policy decision, okay, to make policy with regards to the investee. That's the difference between associate and subsidiary. Okay, associate they only have power to participate, but they don't have the control. Why they don't have the control, class? Because the percentage of acquisition investor over investee is 20% or more, which is less than 50%. To have the element of control, the controlling interest should be more than 50%. But now it's less than 50%, but they have the minimum, okay, which is 20 or more. Okay, remember I said that if the acquisition with the controlling or the acquisition of ordinary share capital is less than 20%, okay, that investee should be considered as simple investment only, okay, because they don't have the power to involve in decision making. They don't have the control, okay, that's why they just call simple investment, okay. But if the acquisition of ordinary share capital is 20% or more, however less than 50%, they have the power to participate, okay, in the decision making. For instance, they are able to elect, okay, who's going to be the board of directors, okay. That's kind of the evidence, okay, to show that they have the significant influence. Okay, over here also I provide some of the evidence, okay, to indicate the existence of the significant influence, okay. If you say that they have significant influence, so what will be the evidence? Okay, some of the evidence will be, okay, representation on the board of directors, okay, participation in policy making, okay, participate only, but they don't have the control over the policy, okay. The words is always participate, okay. Material intercompany transaction, they also are able to have the intercompany transaction between holding investors and also associate, okay. Interchange of managerial personnel, okay. They also are able to transfer their staff from one department to another department, okay, and dependence on technical information, okay. So they depends on the whatever technical information that are available, okay. So you have to look on this evidence, okay, to identify whether that particular investor investors do have the significant influence or not over the investee. Okay, this is the accounting treatment. We have discussed about this earlier, okay, which is should be presented in the statement of financial position, okay, and they're reported as investment in associate at cost, okay. Right, in terms of the accounting techniques, okay, for the statement of financial position, okay, asset and liabilities of associate will not be included, okay. If you are doing for subsidiary, asset and liability should be at column by column, but not for associate. And then the SOP of associate is not consolidated, meaning that if you already identify that particular investee is an associate, all right, in order to prepare the consolidated statement of the financial position or any kind of statement that available, okay, that entity should not be part of the consolidated, okay, of the financial statement. We should exclude their financial statement, okay. We only we're talking about consolidation, okay. We only combine financial statement of holding company and subsidiaries only. Okay, the carrying amount of the investment in an associate will be disclosed as a separate item, okay, which I already showed you just now. This one, investment in associate. Okay, so this particular information or amount, okay, may increase or decrease due to the element of share of the post-profit associate by the holding company. Okay, where the investor share or losses, okay, exceed the carrying amount of the investment account, then the investment is shown as nil. Okay, this one I will highlight it again when we come to the question. Okay, when we're doing the exercise later on. Okay, so because why they said that when the share of losses exceed the carry amount, okay, because we know that investment cannot be in negative form. Okay, so investment should always positive. Okay, the amount should be positive. If you get investment in associate negative form, then should shown as nil. Statement and profit and loss and other comprehensive income. Okay, for the revenue and expenses of the investor and investee which is associate are also not consolidated. However, the only item that should be incorporated in the statement is the holding share of the profit post-profit associate. Okay, will be disclosed as line item in the SOPR. Okay, so normally we put that item as share of profit associate. So share of profit associate, remember we have profit pre and post. So this share of profit associate is related to post profit only. Okay, which is after that an investee become the associate that we're talking about post. Alright, so group statement of financial position, intercompany debts are not cancelled. Okay, remember what you have done for the subsidiary, okay, relationship between holding and subsidiary, any inter or intra-group transaction between holding and subsidiary should be eliminated, okay, to avoid double counting. But if we have intercompany or intra-company transaction which had taken place between holding and associate, should not be eliminated, okay, but shown separately. Okay, when you say show separately, where to show this intercompany in individual statement, not in the consolidated statement. So meaning to say that, okay, even though, because you must know that when you're talking about consolidation or consolidated statement of financial position, okay, holding companies still need to maintain their own statement of financial position together with the group statement of financial position. Okay, so whatever matters related to associate, especially intercompany transaction, okay, with between holding and associate will be disclosed separately in their own statement. Who is their own? They are here referring to holding company. Okay, when the group investment in associate or joint venture is held by a subsidiary in which there are NCI, the NCI shown in the SOPI should include the NCI share of the subsidiary in the results and net asset of the associate or joint venture. Okay, all right. So this statement trying to highlight, okay, or try to tell us that, remember when we are discussing about how to determine the power, the controlling interest. Okay, remember, even though investors own 50% of the shares in the investee, it doesn't mean that the holding company also has the power. Remember, class? Remember? sometimes there are also situation where the holding company acquired less than 50%, but they have the controlling interest or the power. Okay, remember that? Okay, because so far we are only focusing on the acquisition or the percentage is more than 50%, and then we assume that with the percentage also bring together or they also carry together with the controlling interest of power, okay, to control that particular investee activities or any related matters, okay, either even in financial, in operating, decision making, and also the policy making. Right? So kena ingat balik lah. Alright? So it doesn't mean that percentage of control more than 50%, they have the power or they have the element of controlling interest. Okay, so this one sometimes it give you the percentage is less than 50%, but they also can be called as subsidiary. So this is the case. Alright, adjustment. Okay, we're talking about intercompany transaction. So what are the common adjustment, okay, with regards to intercompany transaction? Number one is depreciation. Okay, depreciation. Number two, about unrealized profit. Okay, so unrealized profit actually come from transaction sales of asset. Okay, so sales of asset, okay, in terms of transaction between holding and associate, we need to identify whether sales of asset is upstream sales or downstream sales. Okay, because the treatment will be different. Okay, upstream sales or downstream sales. Upstream sales is, okay, when we have this transaction, of course, what we need to do is we need to identify how much their unrealized profit for the remain unsold inventory at the end of the year. Okay, but at the same time, we also need to know that particular sales, whether involving holding sold asset to associate, or whether associate sold the asset to the holding company. Meaning to say that we need to identify who is the seller. Okay, for the upstream, the seller is an associate. Downstream, the seller is the holding company. Okay, let's look at the treatment, the accounting treatment. Okay, any unrealized profit, okay, related to transaction would be removed. Okay, so remove ke mana? Remove to investment in associate. Remember, investment in associate, which is the item that should be reported in the SOPI, it can be increased or it can be decreased. So one of the event that may affect the total amount of investment in associate actually come from sales of asset. Okay, so EX means example. Example, unrealized profit on inventory. So if the associate is the seller, okay, associate sold goods to parent, so associate is a seller. So this is, we call it upstream sales. Okay, upstream sales goes from down to top. Okay, so upstream. Okay, associate is the seller. So the journal entry will be debit associate profit, meaning that unrealized profit associate ataupun retained profit associate, credit to investment in associate. Okay, if the parents is the one who sold goods to associate, so meaning that the seller is the holding company, so we debit retained profit holding, credit investment in associate. Right? Clear, class? Okay, so if we compare these two, okay, so be careful when we have parents sold goods to the associate, because the transaction will be affected in the retained profit of holding company. Meaning to say that it will be affected share. Alright? Okay, retained profit. If remember you are preparing the schedule, alright, so this item, unrealized profit, with regards to the sales of goods to associate, should be appear in the schedule. Okay, so the good things about this is that both sales, either associate sold goods or parents is the one who sold goods, both only credit to investment in associate. Okay, so in terms of accounting procedure, there are a few steps involved. Step number 1 is always determine goodwill or bargain purchase. Okay, it's not only you determine goodwill or bargain purchase for subsidiary, but for the associate also you need to determine. They also have this step number 1. So however, goodwill is not disclosed separately, but it will included in the carrying amount of the investment. Okay, so the amount of goodwill that will be shown in the SOPI is only the goodwill which related to the acquisition of subsidiary, not the associate. Okay, this is how we're going to determine the template, the formula, how we're going to determine goodwill bargain purchase of the associate. Okay, but if you can refer here, okay, look at here. All right, there's slightly difference as compared to computation of goodwill or bargain purchase for the subsidiary. Number 1, what makes different? They don't have NCI. Okay, normally after we include CT, consideration transfer, we need to add NCI. But the associate, they don't have NCI. Number 2, okay, they also have fair value net asset of associate. Instead of subsidiary, we change to associate at DOA. But wherever total fair value net asset, okay, at DOA should be portioned accordingly. Portion with the percentage of acquisition associate, which the figures here will be less than 50%. It can be 20%, it can be 30%, but it should be less than 50%. Okay, then we get one figure here, then you minus or you compare with the consideration transferred. Okay, if you have positive balance, means goodwill, otherwise it will be treated as bargain purchase. Okay, so from here, goodwill, okay, will not be disclosed in the SOPI, but if the goodwill is subject for impairment, the amount of impairment on goodwill will be affected in the total investment in associate at cost. Bargain purchase definitely will be affected. This one's clear cut. Okay, will be affected in the investment in associate at cost. Okay, let me show you step number 2, the template. Okay, all right. So can you see here? All right, we have 2 unrealized profit. Remember, this is upstream. Upstream means associate is a seller. Okay, associate sold goods to holding company or to parents. So debit retained profit associate, credit investment in associate credit. So tolak. Same goes to downstream where the parent is the seller. Okay, so debit retain profit holding, credit investment in associate. Right, they also minus here, right? Because credit investment. And then both should be multiplied with the associate percentage. Okay, less I less profit, but this one the times whatever at the end should be multiplied with the associate percentage. Same goes to the as I less profit downstream. Okay. And then remember just now, step number 1, determine goodwill or bargain purchase for the acquisition of associate. Alright. So less impairment, if any. If you manage to get goodwill, but there is no information on impairment, means just leave it like that. Okay. So if they have information on impairment, just calculate, find out what will be the percentage for impairment, and then don't forget to put here minus impairment. Okay, bargain purchase, we just add the total of bargain purchase. Then less dividend received from associate. Remember just now, okay, in the earlier part of my lecture, okay, holding company also may subject to receive income from associate, which is in terms of dividend. So we need to minus. So from top to down, okay, then we total out everything. So we are able to get carrying amount of investment at cost. So this is the figure which is highlighted in red color, should be appear, the only item that should be appear in the financial position, okay, which is kita namakan dia investment in associate. Alright, clear class? Are you clear?
InsyaAllah clear.
Okay. So for the exercises, okay, this is only the part of the final assessment. Okay, part B, because question 1 they have part A and part B. Part A is on the case study. Okay, we give you 30 marks. Okay, and this is on the associate, joint arrangement, joint control, okay, or joint operation, joint venture will be examined under question 1, part B, with the total marks is 15 marks. Okay, so meaning that the total marks for question 1 is 75 marks. That's a lot. Okay, it's a lot actually. All right. So this is basically example of questions that related to the topic today. Okay, joint arrangement and also joint venture. Alright, so this is come from July 2017, 2019, 2016. Okay, just give you some different approach. Okay, so we can see that the variety of format, okay, with regards to the question. Alright, June 2018. Alright, June. See, for June itself, they have 2 questions, okay, B and A and B, okay. We're talking about the joint arrangement and also joint venture, okay. And this is July 2021, and then I also include February 2022, which I will show you later, okay, because I prepared different slide for the answer. So on the other slide, I have included the questions together with the solution. Okay, so it's already 9:32. Okay, can we have a break for 10 minutes? Okay, we shall come back at 9:42. Is it okay, class?
Okay, madam.
Okay, so see you after this. Okay, Assalamualaikum.